Hi, today we're going to be talking about cash dividends, stock dividends, and stock split transactions in Learning Outcome 11-3. Investors acquire common stock because they expect a return on their investment, and that return can come in two forms. Growth investment, and those are stocks that pay little or no dividends because these companies reinvest the majority of their earnings, and those stock values tend to increase as the company reinvests the earnings and grows the company. The other type of return they can receive is dividends. They would consider these income investments, and these stocks consistently pay dividends. First, we'll be talking about cash dividends. And cash dividends are a sharing of the company's net income with the stockholders in the form of cash. And in order to do that, you need two things. In order to share your net income, you have to have net income, which means you have to have retained earnings. Recall that retained earnings represents the accumulated net income over the lifetime of the company less dividends. So you need retained earnings in order to declare those dividends, and you have to be careful because sometimes retained earnings have been restricted either by action of the board of directors or some type of other situation, perhaps a loan covenant. Secondly, in order to pay a cash dividend, you need cash. Okay. Now it says here that there are 4 very important dates with regard to a cash dividend, and really there's 3 dates and then there's the closing entry. So let's start with the first one, the date of declaration. On the date of declaration, the board of directors formally declares or approves the dividend, and that's what creates the actual legal liability. You cannot force the corporation to give you dividends until they are declared. On that date, we take the number of outstanding shares and multiply by the dividend per share. Remember, only outstanding shares receive dividends. Treasury stock does not receive dividends. So the outstanding shares represents the issued shares minus the treasury shares. Outstanding shares times dividends per share, and we debit the dividends account, and then we credit dividends payable. On the day of record, our second important date, is the cutoff date for determining which stockholders are going to be paid the dividend. And on that date, there is no journal entry that is needed to be recorded. On the date of payment, that's the day the cash is actually dispersed or paid out to the stockholders. So we would debit this payable that we've created, and then we would credit cash and send those checks out. The final journal entry you learned back in Chapter 4, and that's to close out the dividends account. The dividends account has a normal debit balance, so to close that account out, we will credit the dividends account and we'll debit to reduce retained earnings. And again, we saw that entry in Chapter 4. So now, let's try a problem. We're going to be doing problem M11-8. It says, on May 20th, the board of directors for auction.com declared a cash dividend of 50 cents per share. So May 20th would be your declaration date, the day that the liability is created. The dividend is a cash dividend of 50 cents per share, payable to stockholders of record on June 14th. That means whoever owns the stock at the end of that business day will be receiving the dividend check. So that's the record date. The dividends are paid on July 14th. That's the payment date. The company has 500,000 shares of common stock outstanding. Closing entries are recorded July 31st, and they want us to prepare any necessary journal entries for each date. If no journal entry is required, we have to write that on our journal. Okay, so first of all, on the day of declaration or the declaration date, that's the day we calculate and set up a liability for that dividend. So we're going to be debiting the dividends account for the number of outstanding shares, 500,000, times the dividend per share, or 50 cents, and that equals $250,000. We're going to credit dividends payable because we will not be paying it out that same date. We'll be paying it out on the date of payment. The next date they ask us to be responsible for here is June 14th, the day of record. Now, in the real world, we would not have to put the date here and then write no journal entry required, but in Connect, when you do your homework problems, they'll expect you to do that. On June 14th, on the date of record, the company makes a list of the stockholders who own the stock at the end of that business day, because they will be the folks who will be receiving the dividend. So we have to write no journal entry required here. Our next date is July 14th, and that's the date of payment. And when we pay any payable, since we credit to increase the payable, when we pay it off, we debit the payable. So we will debit dividends payable for $250,000, and we will credit cash because that's what we're giving our stockholders. So May 20th is the declaration date. That sets up the liability. June 14th is the record date. No journal entry required. We just determined who's going to get the dividend. And July 14th is the day we actually pay it. Now on July 31st, they want us to do the closing entry. And since the dividends account is a temporary account, has a debit balance, we're going to credit the dividends account, or do the opposite, to zero that account out, and we will debit to reduce the retained earnings account, because they are no longer retained. The earnings have been given away to our stockholders, so we have to reduce the retained earnings account. And that's our example 11-8. Now let's return back to our notes, and let's learn about stock dividends. So we're going to be on page 5 of 7 here. Stock dividends are just what they sound like. They're distribution of the company's stock as opposed to distributing cash. And they're a pro rata distribution. Pro rata means that each stockholder receives additional shares equal to the percentage of shares they currently hold. And we have a nice example here. Mrs. Walker owns 100 shares of Disney common stock. If Disney announces a 10% stock dividend, then she will receive 10% of 100, or another 10 shares of stock at no cost to her. So now she owns 110 shares of Disney's common stock. Now, why would a company issue stock to their stockholders instead of issuing a cash dividend? First of all, a large stock dividend lowers the market price of a share of stock. Now, you may be wondering why a company would want to lower their market price per share. Don't companies like when their share price rises? That's true, but at a certain point, stock can get too expensive per share, and then folks won't be able to afford it. And when your trading volume drops, that's a bad signal to Wall Street. So they may want to lower the market price of their shares of stock. A large stock dividend will do that, which means more than 25% dividend. 25% or lower is considered a small dividend, and that doesn't have as great an impact on the market price. Another reason why a company might issue a stock dividend is to demonstrate commitment to stockholders while conserving cash during difficult times. Perhaps the company doesn't have the cash to distribute, but they still want to give the stockholders something, so they can give them shares of stock instead of cash. And then finally, to signal an expectation of future earnings. Because stock dividends cause a reduction in retained earnings, companies will declare stock dividends only if they expect sufficient future earnings to replenish the balance in retained earnings after a stock dividend. Okay, now it's important to remember this about stock dividends. They're recorded by transferring an amount from the retained earnings account to the stock accounts, the contributed capital accounts. I've given you an example here of a journal entry for a large stock dividend. You won't have to remember how to do the journal entry, but I want to show you how it works. For a large stock dividend, what we do is we multiply the number of new shares that will be given out to our stockholders times the par value per share. We will debit to reduce retained earnings that reduce the stockholders' equity, and we'll credit the number of new shares times the par value per share, which increases stockholders' equity. In other words, we take money out of one stockholders' equity account, retained earnings, and transfer it to another stockholders' equity account, common stock. For a small stock dividend, the difference is that when we debit retained earnings, it would be for the market price per share times the number of new shares, and we credit common stock for the par value times the number of new shares, and anything extra goes into the additional paid-in capital. But the thing for you to remember is stock dividends do not change total stockholders' equity, because you're simply taking money out of one stockholders' equity account and putting it into another. The last item we're going to talk about right now is stock splits, and stock splits are not dividends. In a stock split, the total number of authorized shares is increased by a specified amount, for example, 2 for 1. In that instance, each issued share is called in and 2 new shares are issued in its place. So in that case, the number of outstanding shares double, the number of issued shares double, all categories of shares double in a 2 for 1 stock split. And again, we would do this to try to reduce the market price of the stock. Let me show you an example from our textbook. This is the bottom of page 518. Prior to the stock split, the company had 1 million shares of 1 penny par value common stock. So the total par value was 10,000. If there's a 2 for 1 split, we take the number of shares and we multiply by 2 so that we now have 2 million shares. We take our par value and we divide by 2, and now we have half of 1 cent. Notice that the total par value does not change. It remains 10,000. And the retained earnings remain 10,000, and the stockholders' equity in total remains 660,000. So in total, the total stockholders' equity and the stock accounts don't change, so consequently no journal entry is required. What changes are the actual stock certificates. So let me just give you an example, another example of those. Let's do a few calculations here. Let's say I have 1,000 shares of stock, and the par value is $10 per share. If we multiply that out, the total par value would be 10,000. If I have declare a 2 for 1 stock split, I take the 1,000 shares, I multiply by 2, and that's now 2,000 shares. And then I take the $10 par value per share and I divide by 2, and that becomes $5 par values per share. When I multiply out, my total par value doesn't change. Let's try one more. How about a 4 for 1 stock split? We take 1,000, we multiply it by 4, so that will now be 4,000 shares. We take $10 per share par value and divide by 4. That will be $2.50 par value each, but again, the total par value remains the same. Consequently, you do not have to do a journal entry for stock splits. You simply call in the existing shares and issue new stock certificates. Let me show you an example here. This was quite a while ago, but this was a huge stock split. Here, you know that guy? Warren Buffett. It's called the Oracle from Omaha because of his expertise in investing in stock. His company, Berkshire Hathaway, offered a 50-for-1 stock split, and that was for the Berkshire Class B shares. Those shares at that time were trading for $3,247 each, and if they split them 50-for-1, they expect that the price per share would drop to around $65. Now, the reason why they did that is because they wanted to acquire BNSF, Burlington Northern Santa Fe Railroad. And in order to acquire a company, they would have to issue Berkshire Hathaway shares of stock in exchange for BNSF shares. And their Berkshire Hathaway shares were way more expensive than BNSF shares, so they had to bring down the value so that they were a bit closer. In the end, they paid $100 per share in cash and then stock for almost for 77.4% of BNSF shares. Now, up to that point, Berkshire Hathaway had never traded on or was never part of the S&P 500 because their trading volume was not great enough. And the reason why the trading volume wasn't great enough was because the stock was so expensive per share. So they were hoping to boost the liquidity, which meant the trading volume, and then perhaps end up on the S&P 500. Now, there's a demonstration that you can look at in the folder that demonstrates stock splits and stock dividends as well. So please take a look at that before beginning your homework.